There we go. All right, I've started recording. So for those of you that are new here, my name is Jason. I am a real estate agent. I've been investing in real estate for about 4 or 5 years now, intentionally. Obviously, my first investment property was about 12 or 13 years ago. It was just a house with a basement suite. But yeah, the actual purpose purchased investment real estate started about 4 years ago. I painted cars for 20 years and was investing in real estate, and those two things had nothing in common with each other at all. So I decided to get my real estate license so that I could be more involved in the market and work with other investors and network and literally have my job be keeping an eye on the market and being aware of current rents and watching the market and just being involved. So I like helping other investors get into the industry. Real estate has created a lot of opportunities in my life. And a good friend of mine got me investing into real estate. And so I'm kind of paying it forward and hoping to get other people into investing in real estate as well. So yeah, that's kind of me in a nutshell. I have been a licensed realtor for almost 3 years now. I am the managing broker of the Pemberton Homes office in Parksville. I'm a licensed property manager, and yeah, that's kind of the long and short of it. So for you, those of you that are new, welcome, and hopefully you can get some good info out of this meetup. It's kind of a little bit back to basics. I covered some pretty in-depth topics in the last couple of meetups where we were talking about agreements for sale and vendor take-back mortgages and kind of creative strategies for increasing rents and stuff like that. But the concept of using debt to increase your return on investment when in real estate is something that experienced investors are well aware of, but it's a difficult concept for new investors to understand. It's a little bit counterintuitive. We're always trained to avoid debt, pay off your mortgage as quickly as possible, things like that. So the concept of making money from being in debt is a mindset that takes a little bit of time to get used to. So it's something that, again, I kind of don't think that much about anymore, but I know that a lot of people, if they're new to investing in real estate, this is something that's takes a little bit of explaining to wrap their head around. So that's why I figured I'd cover it in a topic for today's meeting. So yeah, it might be old news for some of you, and it might be a whole new concept for others. So hopefully everyone can take a little bit away from it. So when I do a share screen here, I'm going to go through it like a slideshow presentation, and unfortunately I won't be able to see any questions or anything if you type any, but if you put them in the chat when I come back to the group here, yeah, I'll be able to see any questions. So feel free to type them out as we go, and I'll do my best to answer them when we get back. So this is us, the Nanaimo Real Estate Investors Group. There's today's date, and yeah, how to use debt to increase your return on investment. So for those of you that don't know, there's a number of different ways to measure how profitable investments can be. ROI, return on investment, is just that. It's how much money you get back based on the amount of money you put into something. There's also cap rates or capitalization rates, which is your net operating income divided by the purchase price. But for today, we're just going to talk about your return on investment, which is the same calculation that you would use for stocks or bonds or real estate or any other form of investment. And yeah, so that's just your investment divided by the how much money you have invested divided by how much money the investment generated and it's usually annualized. So every year it'll give you a percentage rate. So just a quick tip for today. I ran into a major issue this last week with a client buying a property, and of all subjects to get hung up on, it wasn't financing, it wasn't the inspection, it was insurance. Insurance is getting very, very sticky on things. They're it's a hard market is what they're calling it, and they are a little bit reluctant to lend on things that are older, especially if they haven't been updated as far as electrical and plumbing go. If they're non-conforming, this particular one was a fourplex that kind of needed some love, and they just didn't really, we got rejection after rejection trying to find insurance. So I didn't used to ever factor in insurance into my calculations when I was trying to figure out what properties to buy. But going forward, I will definitely be doing that because I'm having to double or triple the expected expense for insurance, and that can really eat into your returns. So if you are looking at buying a property, getting a quote for what the annual insurance will be on that is going to save you a lot of headaches in the future. So when you're investing in real estate, it's much like running a small business. You have customers who are basically your tenants. You have, you might have management if you have property management. You have incomes and expenses and taxes and everything the same way that you would if you were running a small business. And if you want to grow a small business, you need to start leveraging other people, right? So you leverage employees. In real estate, you can leverage trades, plumbers, electricians. A lot of people try to do a lot of stuff themselves, but as you grow and expand, it's best to outsource those things to the professionals. You can leverage people's time. Again, that's what property management really is. You're leveraging someone else to be able to take care of that. Your first investment or two, you can quite often take care of everything on your own. But when you start scaling into having 10, 15, 20 units, it can be too much of a time constraint to try to manage all of that yourself, right? So leverage is key. Leveraging knowledge is obviously a big advantage if you need experts to look at something, and you can leverage the knowledge of your real estate agent to find good investments. You can leverage knowledge on, again, trades or contractors to give you quotes on what it's going to cost to do repairs and stuff like that. But the biggest attribute to investing in real estate is the ability to leverage money. And it's the number one way that you're actually going to make money if you're going to invest in real estate is the ability to leverage money. It's highly leverageable. There's even scenarios where you can get a mortgage with as little as 5% down if you intend to move into the property yourself. There's scenarios where you can buy a property with 0% down if you find someone else to bring that down payment for you, right? If you find the ideal investment property and you can raise capital from somebody and then get a mortgage on top of it as well, you can have a property with none of your own money in it. That's kind of an advanced technique, but even still, your typical house, you can get away with putting 20% down and getting an 80% mortgage. And that, as you'll see, is the difference between a mediocre investment and a really good investment, is that leveraging of money. And that can be leveraging money on the asset you're buying, or it can be leveraging an asset you already have to purchase a second or third asset. So we all hear things about good debt and bad debt. So for those of you that have read Rich Dad, Poor Dad by Robert Kiyosaki, he talks a lot about assets and liabilities. And his definition of assets is basically things that make money, and liabilities are anything that don't, that cost money at the end of the month or the end of the year. Something that's cost you money is a liability. Something that's made you money is an asset. So your car, your toys, credit card, travel, things that are expenses that aren't putting any money in your pocket are bad debt, and you want to avoid bad debt. It's you're paying interest on it. And that's just money that's gone away that you're never going to get back. Whereas good debt is when you leverage something. So a good example of good debt would be if you borrowed $250,000 to start a small company, and that company was capable of servicing that $250,000 debt and covering all of its expenses and generating a profit, then that would be good debt. You've borrowed money to make more money than it costs. So that's what we're going to be talking about, is good debt. And real estate, for the most part, is good debt. Now, I've put your primary residence kind of halfway between the two here. So that can kind of go either way. If you buy a overpriced fancy house for $1 million and it generates no income and you live in it, and 10 years later it hasn't gone up in value and you've been paying property tax and insurance and a whole bunch of expenses on it, then that falls into the liability category. If you buy a house and you have the basement suite rented out and it increases in value over a 5 or 10 year period and you sell it for a profit, then that can be considered an asset. So you really don't know until you buy it, and depending what type of residence you're buying will determine whether or not it's an asset. You also have to factor in that you're going to need a place to live one way or another. So if you're renting a place and it's costing you money every single month to rent that place, but you could buy a place and be paying a mortgage off instead, then that's something that needs to be considered as well. So I'm not against buying a primary residence, but it is beneficial to try to get your primary residence to either be increasing in value or not be a huge expense. So just something to keep in mind when you're looking at leveraged and unleveraged properties, the amount of income that's going to be generated by a property is going to be the same, whether that property is leveraged or not, right? So your monthly income is completely unaffected by whether or not you have a mortgage on that property. Your property is also going to appreciate the same. So if real estate's going up 2.5% a year on average, whether you have a mortgage on that property or not does not affect how much it's going to appreciate. Your operating expenses, now that's not including, usually operating expenses don't include your mortgage. These are things like property tax, insurance, utilities, repairs and maintenance, if you have a property manager, things like that. So those are your operating expenses. And again, those are a fixed cost that are unaffected whether or not you have a mortgage on the property. So this is how you're going to make money from debt in real estate. If we look at an unmortgaged property, so I usually use a $500,000 property as an example. So I mean, this could be a house with a basement suite, and depending where you are, that might be a feasible thing to achieve in the Lower Mainland. I don't think you're picking up a house for that price. Well, once upon a time, you used to be able to in Nanaimo, but now you're having to probably go out to places like Port Alberni to find a house for $500,000 with a basement suite. But you're going to generate somewhere around $2,800 per month of income with that basement suite. So you might get $1,700 for the top floor and $1,100 for the lower floor, something like that. So you're going to have the $2,800 in income. You're also going to have just over $1,000 a year in average appreciation. Now, real estate doesn't appreciate at a set 2.5% a year. As we've seen in the last year, it's increased in value by almost 20%. Next year, it might not increase at all, or it might drop slightly. We don't have a crystal ball. I can't predict where it's going to be, but if you look over any 10 window in time, you're usually going to see a pretty substantial appreciation over that time frame, and it usually averages out to more than 2.5% per year. But we're just going to use that kind of as an example. So that ends up being, on a $500,000 house, about $1,000 a month in appreciation, which isn't too bad. Now you're going to have operating expenses. Obviously, this isn't a mortgage. These are the operating expenses we talked about. So those are going to get deducted from the income, which leaves you with $1,800 a month of cash flow. That's cash that you can actually put in the bank, which isn't terrible. When you add in the someone, I'm getting a lot of feedback here, so everyone can just check to make sure their microphones are off if they're not asking anything. So you add your cash flow together with your appreciation, and you get about $2,800, just over $2,800 a month of total return. So some of that again is cash flow that you can put in the bank, and some of that is appreciation, which isn't cash in the bank, but it's still an increase to your net worth. It's still a net gain in your portfolio. So this generates about a 4.3% annual cash on cash return. Now, if we compare it to a leveraged property, so you've put 20% down, which is $100,000, and then you've gone out and you've got a $400,000 mortgage. And this is just your average mortgage at 25-year amortization at 2.5%, which is kind of where we're at for terms these days. The income stays exactly the same at $2,800 a month. Again, whether it's mortgaged or not isn't going to affect the income. The appreciation is going to remain exactly the same. Your operating expenses are going to remain exactly the same. The difference being you're going to have a mortgage payment. That mortgage payment is going to be about $1,800 a month. Now, the unmortgaged property had about $1,800 a month of cash flow once you took all the operating expenses out, which means once you put a mortgage on the property, this particular property will no longer cash flow anything. It puts no money in the bank at the end of each month. You do get debt pay down. So your mortgage payments are split into debt pay down and interest. The interest is gone forever. Unfortunately, that's a cost of borrowing the money that goes to the bank, and it doesn't build net worth, and you don't ever get it back. That's just a cost of doing business. And that does obviously cut into the return on investment. It is tax deductible, which is nice because you can write that $800 a month of interest off against the property's income that it is producing. So you can see that there's an instant $800 a month loss because of the fact that you're going to be losing $800 in interest to the bank. You do recoup some of the mortgage payment in the debt pay down, but again, at the end of the day, your cash flow is zero, and your total return on investment is $2,041. The total return on investment on the unmortgaged property, the unmortgaged property is $2,841. That $800 again is lost in interest. So it seems like a quick reference. You look at the leveraged property and it looks worse. You have no cash flow. Your monthly return is $800 lower, and that $800 that you've lost out on, that you've paid in interest, is gone to the bank forever. So it should, in theory, be a substantially worse investment. But you have to think, when we're talking about return on investment, we're talking about the income, the money that's generated from the investment. The investment in the mortgaged property is $100,000. The investment in the unmortgaged property is $500,000. So when you run the numbers, these are the actual returns you get. The unmortgaged property is 6.8% annual return on investment. So that is the total return, which is $2,841 a month times 12, works out to about $34,000 a year, divided by the $500,000 investment, gives you just under 7% return on your investment. Now, the mortgaged property generates about $24,000 a year of income, which is less than the mortgage property because of the unmortgaged property, because of the lost money that has been paid to interest. But you're dividing that $24,000 a year of income by $100,000, because that's how much you have invested in the properties, $100,000, not $500,000. When you divide 24,000 by 100,000, you end up with a 24% return on investment. Now, that's a huge difference. For me personally, 6.8% return on investment, if that's what real estate offered for returns, I wouldn't invest in real estate. You can find passive investments that are relatively stable in and around the 7% to 8% range. A lot of people will offer mortgages on kind of unconventional properties, and they're usually looking at like 8 to 10% interest to be a first mortgage on a property. And you wouldn't have to deal with tenants, you wouldn't have to deal with renovations, you wouldn't have phone calls about leaky roofs, you wouldn't have to deal with anything if you were just offering a mortgage at 6.8% to somebody else. It would be completely passive and hands off. So real estate isn't really that good of an investment when you look at it from the fact that if you spent $500,000 on a $500,000 asset, your return is less than 7%. That's not appealing, considering how much work you need to do to invest in real estate. 24% is substantial. You're talking about doubling your money every 4 years. That's a way to build an incredible amount of net worth in a very short period of time. So that's the strength of real estate. That's something that real estate offers that investing in stocks and other forms of investment can't really offer. You can leverage money to invest in the stock market, but that is a fairly high risk scenario, and you really need to know what you're doing. And to leverage stock investments at an 80% leverage ratio is concerning, to say the least. Some people do it, and that's great. That's their thing. I don't see it as a viable, reliable way to make 24% return on investment. And real estate continuously gets better. So I've said this before a number of times, real estate is a great hedge against inflation, because when they start printing a lot of money, which is what they're doing right now, the government trying to bail out, prevent an economic collapse, they start printing money. And as they print money, it effectively devalues money. So when you devalue money, that means everything starts costing more money. Things stay the same value, they just start costing more money. So that forces real estate prices and other assets to increase in value substantially. So when you've leveraged an asset and it's increasing in value, your returns become substantial. So there's the hedge against inflation. There's also the fact that when you buy a real estate asset, you're paying a fixed price for it today. So if you buy an asset for $500,000 today, your biggest expense is that property and the mortgage that comes along with it. But over the next 5, 10, 15 years, rents are going to start increasing and appreciation is going to start compounding. And yet you have a fixed rate of today's price when you buy in. So as rents increase, your return on investment gets substantially better every year that you own that property, as well as the fact that more of your mortgage payment actually starts going towards the principal and less goes to interest. So it's a lot of investors will compare it to planting a tree, a fruit tree. It takes time, but it will start producing more and more fruit. You have to wait a little bit for it to start generating huge amounts of income, but it's only a matter of time before the bulk of your mortgage payments are paying down principal and your rents have gone up 30, 40, 50% in 10 years. And now you're generating a substantial amount of cash flow. So this example of a property doesn't cash flow today, but in 5 years, you can expect that rents are going to be up and it will start to cash flow at that point in time. So you could borrow money at 3% and earn 10% on an investment. How much money would you borrow? This is something a good friend of mine that got me into investing in real estate would say all the time. He would say that he can't sleep at night without debt. He said he will take as much money as the banks will give him. He'll take every single dollar. And I couldn't wrap my head around that. It seemed reckless, extremely high risk. until I started understanding this concept, is he was getting mortgages at a very low interest rate of 2.5, 3.5%, and he was investing it in properties that were generating, well, substantially more than 10%. A lot of them were generating 20, 25, 30% returns. So he would borrow as much money as he possibly could, because every dollar he borrowed from the bank, he could generate an incredible return on. So the more money he borrowed, the more money he made. Again, very counterintuitive to how we were raised to pay off your mortgage and avoid debt at all costs. But again, leveraging money to make money is a great way to build net worth and equity extremely quickly. And again, is the reason why real estate in particular does better than most other asset classes. So you can buy a $500,000 house for $500,000, or you can buy 5 with the same money. So again, it's, if you're borrowing at an 80% ratio, you only need 20% down. So that would be $100,000 on a $500,000 house. So essentially, if you had $500,000, you could buy 1 house cash, or you could buy 5 with 20% down. And as you've seen in the return on investment that we went through, you can leverage your money so much further that's where you're going to see the exponential growth that you're not going to see by buying 1 single asset when you can leverage it into 5. So another factor is appreciation. Again, if you bought a property and paid full cash for it and it appreciated 5% in a year, that's a 5% return on your investment. Now, if you've only put 5% down on a property and it increases in value 5%, you're actually going to double your money. So in this case, 5% down on a $500,000 house is going to be $25,000. If that house goes up in value $25,000 in a year, which isn't unreasonable to think of it happening, places have gone up substantially more in the last year here, you would essentially double your money in the first year. Now that's a return on investment that is pretty hard to match in any other market. So I understand that people are risk adverse, and the idea of leveraging is a bit concerning because of the fact that your returns, your profits are amplified by leverage, but your losses can also be amplified. So if that property, for example, decreased in value 5% and you only had 5% equity in the property, you've essentially lost your entire investment. If you plan to buy for a short period of time, if you plan to buy a property and sell it in 2 or 3 years, I don't recommend buying real estate. I can't predict that real estate will be worth more in 2 or 3 years than it will right now. On top of that, you have property transfer tax, lawyer fees, real estate agent fees. There can be a lot of costs associated with buying and selling property. So if it's for the short term, it's likely that it won't be profitable if you need to sell within a year or 2 of buying. If you look at it, if you zoom out and think of about a 10-year span in time, I don't know of any 10-year span in time on Vancouver Island or the Lower Mainland or even Prince George and places like that where real estate has been worth less 10 years later. There's definitely times where 2 or 3 years later it's decreased in value, but typically you'll see a 2-3 year kind of slump or recession where it levels out, maybe sees a little bit of depreciation, and then sorry, it comes right back on track, and then you see the appreciation after that. On top of that, you're not dependent on the appreciation to make money in real estate. That's the icing on the cake, and most real estate investors won't even factor appreciation into their equations. That's the bonus at the end if you choose to sell. The bulk of the money, again, comes down to debt pay down. So when you buy that $500,000 house and you have a $400,000 mortgage, in 25 years, you've paid off $400,000 worth of mortgage that wasn't your money. So that's the real advantage. So all you need to happen in that 25-year window is for that, that property to remain rented. So you're really speculating just on the aspect of people living in rental units. And there are some towns like Detroit, for example, where the rental market kind of dried up and there was a pretty huge exodus of the city, and the vacancy rate was very high and very difficult to obviously rent places. It's not something that I'm familiar with in any major Canadian cities. There is always that possibility, but I always recommend to not invest in one-trick pony towns. Towns that are their main industry is linked to one particular service or one particular product. If it's just a forestry town or just a fishing town or a gas town or oil town, and that one industry takes a hit, then you're going to see a huge fluctuation in prices and vacancies. So Fort McMurray is a good example of that. When it booms, it does really well, and when it busts, it can be a nightmare. So invest in stable cities, invest in Nanaimo, invest in the Lower Mainland, invest in cities, Prince George, places that have a big enough population and are stabilized enough that they're not going to become ghost towns if an industry shifts. So you're really just investing on people living in a city. Quite often in a recession, when people are getting foreclosed on and are essentially having to go from being homeowners to renters because they've been foreclosed on, the vacancy rate actually decreases. So rents can quite often go up during a recession. And when prices start increasing quickly in housing, like we've seen in the last year, it starts pricing people out of the market, which means there's a lot of people that are stuck continuing to rent because they can't afford to purchase a property. So when the market's doing really well or the market's doing very poorly, you always have a surplus of tenants. So if there is any downturn in the real estate market, you're not focused on the value of the property. You're really focused on tenants being in that property and paying down the mortgage. So I view it personally as extremely low risk. I view it as the lowest risk asset you can buy. Food, water, and shelter are necessities in life. You're investing in shelter. Anything else is a speculation. I mean, you could even invest with Toyota or Tesla or another company, but people don't have to have cars. People do have to have housing. So when there is a recession, people stop buying things like cars, but they still have to have a place to live. And that's why you have companies, major banks, and companies like CMHC, the Canadian mortgage housing company, that will lend huge amounts of money at very, very low interest rates for residential property because they view it as the lowest risk asset. So I work with a investment group that recently refinanced one of their multifamily units in Nanaimo, and they got a CMHC mortgage on it. And they were offered a 40-year amortization at 1.5% interest rate, which is unheard of how low it is. And it's because there's a bit of economic turmoil right now, and banks need to get their money out into the field to start generating some form of income. And they're very speculative and concerned about investing in something that might not do well. So they're investing in what they know will perform through any recession, and that is residential real estate. They don't even really want to invest in commercial or industrial real estate because even that can shift. So they're really doubling down on residential real estate because they know that no matter what happens, that's going to come out the other side okay. So when the big banks are deciding that that's the lowest risk asset to invest in, that's should be a pretty good signal to you that that's the safest place to park your money. So when you can invest your money in what I view as the safest asset and generate 24% return on your investment, it's a no-brainer to me. I'll take that all day long over any form of investment. So you need money to leverage to get into the market. So for a lot of us, we've saved up a down payment, but for some of us, we are stuck to buy the first investment property or our next investment property. So here's some of the places you can look to get money. A lot of people have a lot of money in their primary residence. So you can take that out in the form of a home equity line of credit, or you could remortgage the property and get a lot of money out. I know my father-in-law is pretty much done paying off their home in Maple Ridge, and there's a substantial amount of equity in that property, and he says that that's the secure money. You don't touch your mortgage money. That's the safest place to leave it, and he has no interest in taking it out. And for me, I see $800,000 of capital that's doing nothing for you. It's making you no money. And if he could take that money out and buy an investment property that was generating more money than what it would cost him to service that home equity line of credit or that mortgage, he could be generating huge returns from it. So again, it's a mindset that's difficult to overcome when you start getting close to paying off your mortgage, or if you have a couple $100,000 of equity in your property. The concept of remortgaging and going further into debt is unappealing. But when you look at the fact that you can borrow at 2.5% and generate probably 20, 25, 30% return on that money, it's a bit of a no-brainer. The other advantage is if you pull money out of a home equity line of credit to use as the down payment for an investment property, which is then going to be mortgaged as well, you've essentially borrowed all of the money to buy that property. You've borrowed the money from your HELOC for the 20% down, and you've borrowed the 80% for the mortgage to buy the property that's 100% mortgaged. If that property generates any form of income at all, your return on investment actually becomes infinite, because you're generating money on $0 investment of your own money. So it's a kind of a creative way. When you explain to somebody that you can make an infinite return on your investment, people kind of roll their eyes, but it's actually pretty simple. One of my co-investors that I've bought 2 properties with mentioned he had listened to a podcast and had heard that it was possible to make an infinite return on your investment by borrowing money from somebody else and then using that as a down payment to go and get a mortgage on an investment property. And I explained to him that he has already done the same thing. He borrowed the money from his condo in the form of a HELOC to buy an investment property, which we got a mortgage on. So he essentially borrowed all of the money for the investment property, and he was generating an infinite return on his investment. And when I explained that to him, he seemed pretty happy and pleased about it. So it was, a great way to utilize capital that's in your property that's not making you money. There's RSPs. You can cash them out. I believe you have a certain amount of time you can pay them back. There is also, I am not an accountant and I do not know how exactly this works, but you can borrow against your RSPs if you invest through a third party. If you take your RSPs out and use them directly for buying real estate investment, you do have to pay the gains, the income tax basically from cashing out those RSPs. But I believe you can use those RSPs to invest through a third party that buys an investment property for you. I don't specialize in that, but there are companies that can explain that to you. Maybe even your accountant can explain that to you, but it's definitely an option to have money that, again, might be earning 2% or 1.5% interest rate, and you can take that out and invest it in something that's generating a 20% return on your investment.
Hey, Jason, can I ask a question?
Sure.
Hi, it's Carly. Just on that infinite thing you're talking about there, yep. Just if you remortgage your house and then you're living in the house, so now you're going to be paying for a lot longer. What about that aspect of it? Like, unless you have a rental in your house, so then you're still paying off your rental with somebody else's money. But if you're paying that off, you know what I mean? Like,
yeah. So the concept is, if you borrow, say you took $100,000 out of your home equity line of credit and use that as a down payment to purchase a property, you obviously have, you're going to be paying interest on that money. So if you borrow at 3%, you're going to have that monthly bill of whatever it ends up being, $270 a month or whatever of interest that you need to service. So as long as the property that you're buying can pay for itself and generate $270 a month of income to service that debt that you've taken out on your home equity line of credit, it's of no cost to you, right? So even if you factor in that you've now extended your mortgage, or you've increased your mortgage and you're going to be paying for it for longer, or your payments are bigger, the difference is that debt is being serviced by something else. So it's really of no cost to you. Again, if you can borrow at 3% and earn 10% on the money you're borrowing, by the time you pay back the 3%, you're actually still holding 7% return for yourself that you get to keep, right? So you've alleviated yourself of the debt. You're taking out $100,000 and you're getting someone else to pay it back. And that's other people's money. That's the whole concept of leverage, is somebody else is going to pay back the debt that you've taken out. And I often try to explain it in the way of, when people are kind of making the decision whether or not to buy an investment property or go and buy a new boat or an RV or a truck or whatever it is, I say, well, buy the house and make the house pay for the truck or the RV or the boat. So if you can find a property that's going to generate $400 a month in cash flow, and you buy that and that covers your new car payment, well, then the car was free. It's been paid for by the asset. And once that car is paid off, that asset's going to continue to pay money and is going to continue to appreciate. So it's just a way to not pay for stuff yourself. Get other people to pay for stuff is the long and short of it. Hopefully that answers your question.
Yeah, that totally makes sense. Thanks. That's awesome.
No problem. Yeah, stocks and bonds, you can obviously cash out stocks or bonds to invest in real estate, but you can also sometimes borrow against them. If you have a substantial amount of money in very secured, low risk bonds that, they only yield whatever 2% return, but if they're locked in there, sometimes you can actually borrow against them, and the bank will basically put a lock on them that won't allow you to withdraw them while you have borrowed against them. So if you have $200,000 worth of bonds, they might allow you to borrow $150,000 and hold those bonds collateral, so that you can't cash them out, but you can use that $100,000 to then go in and buy another piece of property. And again, if that piece of property covers the interest being paid on that borrowed money, as well as all of its own costs, you're generating an infinite return on your investment. Even if it doesn't cover all of the costs, the money that you might be making on that investment property, you might be paying off a lot of debt and seeing a lot of appreciation. So you might be making $20,000 a year of equity in that property, in debt pay down and in appreciation. But you might have to, but say it generates zero cash flow, so you might have to service that borrowed money from your HELOC or from your stocks or bonds, and you might have to service it with $300 a month out of your own pocket. And that's not an ideal circumstance, but it's still going to be a huge net gain, because if you're gaining $2,000 a month in equity, but you're having to pay $300 out of pocket each month to have that equity growth, you're still net up $1,700 a month for using someone else's money to make money. Hopefully I'm not losing too many people here. It always makes sense in my head because I've been conditioned for it to make sense, and I understand it, but sometimes it's difficult to kind of explain it in a way that makes sense to everybody. Another option is friends and family. There's a lot of people out there that want to invest in real estate, but they either don't have the knowledge or they don't have the time, and they might be willing to partner with you on that, which is joint ventures as well. So, I mean, there's kind of two different ways to structure. If you're going to partner with somebody on a property, you can capital raise, you can borrow the money from somebody, from friends or family. Say, I'm going to borrow $100,000 from you, but I'm going to pay you X number of dollars per month and then you go and you get a mortgage on a property and you buy it yourself. That's just a capital raise. A joint venture is when you co-buy that property with somebody else. So you're actually both on title and you both contribute something. Maybe someone manages the property while the other person brings the capital. I've talked about this in previous meetups as well, about how there's various pieces to any investment puzzle. Knowledge, the time to manage property, and the down payment and the ability to borrow money are kind of four key components to investing in real estate. And you may not think you have something to bring to the table to offer people, but it's of major value to a lot of people if you qualify for a mortgage, or if you intend to, say, buy a fourplex and you're going to live in one of the units and the other 3 units cover all of the expenses of the property. You can get away with buying that property with only 5% down. That's a huge value to an investor that has to, instead of having to come up with 20% down, they only need to come up with 5% down. So they might be willing to partner with you. They might be willing to come up with that 5% down if you're going to live in the property and manage the property. And you've now basically found a way to live for free in a fourplex that you own 50% of. The investor's happy because the down payment has been reduced substantially. So there's a lot of ways to structure investing in real estate and finding the capital to invest in real estate. But yeah, I have already done a meetup about joint ventures and partnerships and kind of the different ways those can be structured. That's a conversation on its own. So I won't go too in depth there, but these are just kind of a few ways of investing in real estate if you don't necessarily have cash burning a hole in your pocket. The other big issue about buying a property cash versus buying a leveraged property, if we go back to the $500,000 house example, a lot of people don't have $500,000 cash. That's a lot of money, and it's going to take a long time to save up that $500,000. And if you buy one, how long does it take you to save up the next $500,000 to buy the second one? It could be a lifetime. So to just put $100,000 into one enables you to get into the second, third, fourth, and fifth properties significantly faster. And as those appreciate and pay down debt, you're building equity so much faster that they can be leveraged into multiple properties. That's how you see people with a portfolio of 5 units, 10 units, 50 units, or 100 units. It's not that they had the money, the down payment. It's not that they worked really, really hard at their job and saved up enough money for a down payment on $4 million worth of real estate. That's not how it happened. It started with one. That property appreciated, and some debt was paid down, and they leveraged it. Within a year or two, you can usually leverage a property, get into the second one. If you bought a house a year ago, it's probably increased in value $100,000. In theory, you could leverage that property right now to buy your second house. So all of a sudden you go from 1 to 2 in a year. If you need the full amount of money to buy the asset up front, you need that $500,000. It's going to be a long time before that property generates enough money for you to get into your second property. So the scalability of real estate and getting equity out of your properties because of how little you have in there and getting them into the next one is another huge advantage of how people scale into huge assets relatively quickly in a short span of time. People think that there's some trick to how these people ended up with dozens of units, and it's kind of amazing how quickly it happens, especially if the market's climbing. It's pretty easy to get your money out, and there is a strategy called the BRRRR method, BRRRR, buy, rehab, rent, refinance, repeat. And that speeds up the process. That's buying properties that require some form of remediation or work to them, getting them at a discount because of that, doing the remediations or the repairs or the renovations to increase the value, placing tenants in that property so that they're easy to remortgage because they're generating good income. And when you remortgage it, you get that capital back out and you can get into the next property in a very short period of time. And if done correctly, you can end up picking up 2 or 3 or 4 properties per year, and you can scale it into something pretty significant in a very short period of time. So that's kind of all I've really got for this week's meetup. I don't know if anybody, I'm going to check the chat here. I got some questions in here. All right, so Simon says he uses his own money to pay for renos. Yeah, that's lending money, borrowing money to do renovations can be difficult. So there has been times where I've borrowed money to buy the property, but I needed to have the cash to do the renovations myself, and then I refinanced afterwards. It is kind of cash intensive up front to do that. Don't cash out, lend out your RSP. So yeah, I think that's what I was trying to mention. Again, I'm not an expert on that, but I believe, yes, you can lend your RSPs to a third-party investor that will invest it in real estate for you. I don't know exactly how it works, but I know it's done. And then you don't have to liquidate those RSPs. They're still there. You don't have to pay the income tax on them because they haven't technically been cashed out. So yeah, that's definitely not my expertise. There are people that kind of specialize in doing the RSP lending and stuff like that, but that's not really what I've done before. Christoph says, yeah, he's done just what I'm talking about, 80% mortgage, and the entire down payment was funded from a line of credit on the primary residence. Yeah, definitely not what I was told growing up, but a no-brainer. So yeah, it's people see that their savings account, their primary residence, when they have their mortgage paid down a lot, that's kind of their savings account. That's their nest egg. They view it as sacred money that is a huge amount of equity. I see it as dead money. It's not making you money. If the property appreciates, then you do make money on your property. That's true. But again, we talked about the fact that that property will appreciate the same amount, whether it's leveraged or not. So if you have a primary residence worth $1 million and it's going to go up 5% next year, you're going to make $50,000. If you pull out a $500,000 mortgage on it and go and buy another investment property somewhere else, that property is still going to increase in value $50,000. It really doesn't matter. Your appreciation doesn't change based on how big your mortgage is. So that money that's locked in your mortgage is really dead. And if you can find a way to get it into other assets that are going to generate money, you can start leapfrogging and compounding your money very quickly. Can you further discuss per diem HELOC payments? So HELOCs can be kind of structured in two different ways. Sometimes they're interest only. So you put a $100,000 home equity line of credit on your property, and it will be interest only payments. So you might accrue $350 in interest in a month. So your borrowed money goes up to $100,350, and then they will take out a $350 payment out of your bank account to bring that mortgage back down to $100,000, and it will basically stay at a $100,000 line of credit indefinitely. There's also ones that actually take money and put it towards the principal, so it actually pays the interest as well as starts paying down the home equity line of credit. So it really depends. But again, if your home equity line of credit is $350 and you can find a property that pays all of its expenses and generates $350 a month of income, you are essentially paying that HELOC off with something else, with someone else's money, so it's of no cost to you. Simon Freeman, information, other registered funds you can lend out of our RESPs, TFSAs, and LIRAs. Yeah, so I think you can, that's right, you can borrow from your tax-free savings account. Yeah, Simon sounds like he knows a whole lot more about investments and borrowing against investment funds and stuff like that. That's not, I'll be honest, I don't have any tax-free savings accounts or RSPs or anything. I put every single dollar I have into real estate, just my personal investment philosophy. I keep getting bugged by family members that maybe it's smart to diversify and put some money in some savings account somewhere. And when I see that, yeah, I can earn 2% or I can earn 24% in real estate, I can't handle the concept of having money in the bank earning only 2%. That's just me. Teach their own. That being said, those said family members that like to diversify and put money into RSPs and tax-free savings accounts and mutual funds and stuff, I've made a lot more money than them in the last few years. So yeah, that's just, I'm not going to get into why real estate's better than stocks, because to each their own, but yeah, real estate's better than stocks. But yeah, so I don't know if anyone else has any other questions about investing, about leverage. Yeah, hopefully people are kind of wrapping their head around this. The first time I talked to my friend that got me into investing in real estate, and he was saying, I want as much debt as the banks will give me. I want to borrow every dollar I can. I thought he was totally crazy. It sounded just totally uncomfortable to me. And every single time I talked to him and he explained it better and better and better, it started making more and more sense. And then I also started seeing him grow from 1 house to 3 houses to 5 houses. His goal was to buy 10 houses in 10 years, and he ended up with 11 houses in 8 years. And it was starting from nothing. The growth was amazing. And once he explained how and why, my views changed pretty quickly and pretty drastically on the idea of borrowing money. So it's something that takes time to wrap your head around, but hopefully I've explained it in a way that makes sense to people. But yeah, if anyone needs any clarification, yeah, I'm definitely here to answer questions or try to explain stuff.
So I was doing some number crunching last night on some different properties. I was looking at some in Port Alberni and just some that are currently rented out. Like there's a couple fourplexes up there for sale.
Yep.
And they kind of just sort of break even still, or they'll, like if I was to take off, because I was listening to more on that rental property book today that went over all the expenses you should take off, like the long-term, like take off money for the roof and all that. Yep. So I just did the basics, the insurance, tax, mortgage, and maintenance. So I was making like $1,000 a month off them at that point. But then if you take off the other items, and like, I'm just wondering if you can actually get to a place where you're having some cash flow at the end right now with the difference in mortgages and what
definitely.
Rents are.
It's definitely harder than it has been from a year ago, right? So a house with a basement suite again in Nanaimo a year ago, you could pick up pretty easily for the $500,000 range. Now that house is like $650,000, and that difference in the mortgage is the difference in the cash flow, right? So that has increased your mortgage payment by $400 or $500 a month, and the property would have cash flow $300 a month a year ago, and by today's standard, it is actually running at a cash deficit. A lot of properties are underperforming right now because they're under rented, and it's very difficult to get rents up in BC. For anyone that is aware of the Residential Tenancy Board, you can't just increase rent. You can't just evict people if you want to get higher rent. It's very difficult to get rents up. So a lot of assets are underperforming really drastically, and they won't cash flow the day you buy them. And you need a very creative strategy to try to increase rents to make those properties work. You do have to kind of think outside the box and look for kind of odd properties. I have a client that has found a number of properties that actually cash flow as is really well, but they're things that you wouldn't have necessarily thought would work. One of them was a $700,000 house in Lake Cowichan that had 3 bedrooms up and 4 bedrooms down, and was going to generate about $4,500 to $4,800 a month in rental income because of the size of the house and the fact that it had a lake view. So it actually worked. It actually was going to cash flow quite well because of how high the rents were going to be. But again, typically you would think that a $700,000 house is too expensive to work, but when you ran the numbers, it did work. So you have to start analyzing a lot of properties and running the numbers on them before you start recognizing what can work and what won't work. And if you can find underperforming properties that are under rented and have a creative strategy to get rents up. I talked in the last meeting a little bit about the tenant upgrade packages. So you offer to upgrade the tenants unit with new flooring, new paint, new kitchen cabinets, new appliances for an agreed upon rental increase amount. So maybe they're paying $600 a month, but you say, hey, I'm going to put in new appliances, new flooring, and paint this place. Are you willing to pay $900 a month if I do that? And even though there is a capital expense of doing that renovation, that $300,000 or that $300 a month will qualify for basically an extra $100,000 worth of mortgage. So in the long run, it becomes it's something that can happen. So there are strategies that work, but yes, it is getting harder and harder to find cash flow. Port Alberni still works. Places like Prince George still work. But yeah, they're getting harder and harder to find in places like Nanaimo.
What are your thoughts on Port Alberni? I keep hearing that it's the next little Squamish. I feel like it might turn into something.
I don't really like it. It's not a nice place. It's not where I choose to live, but I own an investment property there and it's done very well. And people complain about the tenant profile in Port Alberni. And my experience has not been bad at all with the tenant profile there. I find that there's a lot of slumlords that have really, really horrible rental units there. And then they're shocked that they attract horrible tenants. And to me, I've viewed those units and I realized quite quickly that it's the landlord is the problem, not the tenants, right? So my rental units there are very nice and I've had awesome long-term tenants and I've never had any issues and I've had 0% vacancy there since I've bought. So yeah, I think it's still a place that actually works quite well.
Awesome.
And yeah, so Marion says, take a look at the Smith maneuver. So yeah, the Smith maneuver, I actually talked to my accountant about this and asked her the details about the Smith maneuver. And she wasn't familiar with the term, the Smith maneuver, but was aware of the how you do it. So if you borrow $100,000 from your home equity line of credit from your primary residence, and you use that $100,000 to invest in an investment property, you can write off all of the interest on that $100,000 line of credit because that was a cost that was incurred by you to buy an investment property. So it is a write-off against that investment property. So there's lots of tax incentives when it comes to investing in real estate, and write-offs are one of them. Again, if you're paying $800 a month in interest on an investment property and you're paying $300 a month of interest from your home equity line of credit that you use to buy that asset, that is all completely deductible from the income that property produces, which is nice because when you start paying off mortgages, you start paying a lot of taxes on properties. They start generating a lot of income, and it's nice to have some write-offs. So even though the interest obviously eats into your cash flow, it helps reduce the taxes that you're paying. So there's a pro and con to everything. Obviously making more money is better, but having tax write-offs is nice too. Yeah, Jason asked, which is better, single family home or duplex? Have I heard of Carl's calculator? I have not heard of Carl's calculator. I don't know what that is. Yeah, I'm not sure if you want to put a quick comment on maybe what Carl's calculator is. Single family homes, it depends if you mean like a duplex as in like a legitimate conforming duplex. versus like a house with a basement suite. Like a single family home, as far as like a rancher, are very difficult to make cash flow. Usually they're only a little bit less money than a house with a suite, but they don't generate nearly as much income as a house with a basement suite. And duplexes, again, are similar to houses with suites, but I find like legitimate duplexes are quite often kind of overpriced in comparison to a house with a suite. So, but there are pros and cons. Usually duplexes actually have 2 separate meters and advantages like that. So like splitting services and stuff makes it a little bit easier on a conforming duplex. I don't recommend ever buying half of a duplex. Duplexes are technically stratas, and if you buy half of a duplex, you are buying half of a strata, and that strata is usually a non-existent strata with no contingency fund and no strata meeting minutes and nothing. And if the roof starts leaking on the duplex and you say, hey, it's time for us to put a new roof on, and the neighbor says, no, I'm not doing it, so you decide to put a new roof on your half of the duplex, the neighbor can then come over and knock on your door and say, hey, now I think it's time for us to do the roof on my half of the duplex, and you are going to be on the hook for half of his roof. So, and if you want to force the owner to put a roof on the entire complex and have them pay for half of it, you need to actually take your owner hat off and sue or charge the strata, force the strata to pay for it, basically take the strata to court to force them to put a new roof on, and you're essentially kind of suing yourself to actually force a strata to put a roof on the complex. Anyhow, long story short, don't buy half of a duplex. They're a weird, not strata, but our strata kind of scenario. Yeah, tread very lightly in that. Buying the whole duplex isn't an issue. You run the whole thing, so it's fine. What else have we got? Marion and Merlin put a link to understanding the Smith maneuver. So yeah, that could be good. I think I gave kind of the Coles Notes version, but I think there might be a little bit more in depth as to how the Smith maneuver actually works. Yeah, Simon says he walked away from many properties because of existing tenants. And yeah, it'll be underperforming at the sale price. And that's actually a huge issue that we're finding in small multifamily, because usually when you're dealing with multifamily properties, a 6-plex or an 8-plex, the lending value of the property is based on the income of the property. So when you're buying a primary residence, your house, they look at the owner's ability to service the debt and how much the house is worth in comparable to other properties in the area. When you look at commercial property, so you're buying something specifically for the income aspect of it, the bank looks at how much money it generates and if it's able to service its own debt. And usually they look for like a 1.2 or 1.3% or debt service coverage ratio, meaning if it has $100,000 worth of expenses in a year, including the mortgage, they want it to make $120,000 of income. They want that buffer there. So if something is underperforming, if it's really under rented, it really makes it difficult to hit that debt service coverage ratio to make sure that it can service its own debt. So even though there might be comparables that are a very similar building and similar condition, if one is rented at $600 a unit and one is rented at $1,200 a unit, the $600 a unit will be literally half the value of the $1,200 a month unit, just because of the fact that it's the lendability of that property based on the income that it makes. So a lot of these landlords have owned buildings for 10, 15, 20, 30 years, and they've been doing very, very small increases in rent or not increasing rent at all. They might not even know what current rent is. And so they have these underperforming assets. And when they go to sell them, the deals fall through again and again and again because the banks aren't willing to lend on it, just because of the fact that it doesn't generate enough money to service the debt, and there's no creative way to get rents up.
So question on that, I know the rules have changed around evictions to renovate. you have to pay the tenants a certain amount for how long they've been there. Is that not something that's possible if you're trying to buy something that needs a renovation and get a mortgage on like a construction loan for a fourplex or something?
You can. The issue, and that what you're talking about is they're talking about bringing it into play, but I don't believe it's in play yet, where you have to pay based on the amount of time they've been in. I think that might have actually been something that they were talking about bringing it in Victoria. But as of right now, you need to do a renoviction is the term that they use to kick a tenant out, to do the renovation, and then put new tenants in. You need to give them 4 months notice. You need to pay them the last month free. You either need to rebate them the last month or give them the last month free. And quite often now they'll want like quotes for work to be done by contractors saying that, yeah, we're going to need to do it. You need quite often proof that the property won't be habitable for the time that you're doing the renovation. So you're completely removing the bathroom and there's no way that a tenant can live in there with no bathroom or no kitchen. So there is certain requirements to make sure that you can actually do the renovation. But the difficulty is lending up front is you might have a plan to get the tenants out and do those renovations, but the bank wants to know how you're going to service that mortgage tomorrow. They don't care about in 6 months' time. They need to see what it's capable of doing today. Even if a property is completely vacant, that can be difficult because you can say, hey, I can place tenants in there immediately. I want to buy the sixplex, all the units are empty. I'm going to place tenants in there at $1,500 a unit and it's going to make lots of money. The banks are very skeptical about that because they don't have rental agreements in place. They don't know, they don't understand that the vacancy rate is very low and that you're going to have an easy time placing tenants. They see a property that you're going to owe $5,000 a month in mortgage payments on, and it's generating $0, and they just say it doesn't check the box. So different lenders have different criteria, and some are willing to be a little bit more flexible than others. But typically they need to see that current rental income be able to service the debt, unless you're getting some special lender that is willing to see the project from the grand perspective and understand what your plans are. And in that case, and there are lenders out there, private lenders and commercial lenders that will view those properties and they will lend to you at a very high interest rate. I recently picked up a threeplex in Cowichan area, and it's very under rented. And we had to borrow, they would only lend us 65% loan to value ratio instead of 80%. And we have to pay an 8% interest rate, which is really high and really, really crippling. We have plans to get the tenants out, get new tenants in, increase the rent on the existing tenants. We've done an upgrade package where the tenants have agreed to pay higher rent and then we're going to refinance. So this is very short-term mortgage. We're paying the 8%, but we're hoping that it's an open mortgage. So within 6 months, we're going to refinance with traditional mortgage on that. So yeah, there are lenders that will work with a property if you have a plan to get rents up, but they're going to be charging you a premium until you kind of complete on your plan.
Was that Francis Street you bought?
No, I saw that one too. No, it was an off-market deal. It's actually in Yubo, however you say it, on Maple Ridge.
Oh, wow. Good job.
Thanks. Yeah, so Jason says that Carl's calculator allows someone to determine the interest on a mortgage for accounting purposes. Oh, okay, so yeah, if you go to your bank statements or go into your bank and at the end of the year, ask them to print you off a mortgage statement for the previous year. They will print something off that actually tells you exactly how much went to principal and how much went to your interest, and then that interest is tax deductible. So, but yeah, if you're looking to calculate ahead of time, there you go. Carl's calculator will tell you how much is actually going to be going to principal, to debt pay down. And if you're trying to calculate a return on investment, that is an important number to know how much is actually going to be going to paying off debt. That calculates into your equity building. And with current interest rates, it's actually usually, depending on your amortization, it's actually you're paying over 50% is actually going to the debt pay down. But if we go back to say 5 or 6% interest rates at the beginning of your amortization, only about a third of the money actually goes towards debt pay down. So it's a little bit frustrating at the beginning. You're making big payments and only a small amount of it is actually paying off any sort of debt. So we are in a wonderful time right now as far as interest rates go. Yeah, you can borrow a lot of money for really cheap, which is great for leveraging. Unfortunately, because the money is so cheap, people are paying a lot more money for houses, which is causing prices to go up. So it's the market kind of ends up dictating how how affordable it's going to be based on interest rates. So it all balances out in the end. Do I agree that now is a good time to refinance? Yeah, I don't see rates going down anytime soon. And from what I've heard, that, well, they've already climbed a little bit. The stress test just increased as of, or sorry, June 1st, the stress test actually increases. So you're going to actually have to qualify for a slightly higher interest rate than previously. I don't foresee interest rates dropping substantially. If anything, I think they're going to go up. So depending on what type of penalty you're going to pay on your mortgage for refinancing, I would definitely recommend doing it right now. And I'd lock in for as long as possible. That makes sense. If they want, quite often, if you go for a 7-year term instead of a 5-year term, they might actually want a much higher interest rate because they know that interest rates are very low right now. So you have to play with the numbers to see what works for you. But yeah, I recommend you locking in for a 4 or 5 year term right now because interest rates are very, very low.
Hey,
Yeah.
Jason, yeah, if it's possible, can you touch a little bit about like these strategies of changing the tenants and like creative ways to remove them? You know, like because like for example, like these packages you're saying like the renovation in exchange to the price increase, and what else? I mean, what else are you guys doing?
So it is difficult right now, and even the renovation scenario where you give them 4 months notice and then you go and do a major renovation and place new tenants at market rent afterwards. I mean, that's kind of been a go-to for a lot of people for a long time. It's tough because if you have somebody that's been living in a unit for the last 20 years and they're paying $700 a month and that unit's now worth $1,500 a month, and they're on a fixed income and they can't afford more rent, it's uncomfortable. It's tough to go through the renovation process, right? That's not one of the things that I'd like to see as far as investment strategies. In the last meetup, I was talking to Guy from Top Down Investments, and he said that like in the future going forward, when they're buying multifamily, they're not going to even contemplate that that way of doing business anymore. It's difficult, it's time consuming, and it's not fair to the tenants. The tenant upgrade packages have been definitely a substantial improvement on that, because a lot of times the tenants, they're living in not very nice places and everybody wants nicer stuff, so they're willing to pay a little bit more money for nicer stuff, right? Where you run into issues is properties that are under rented that are actually pretty decent, they're okay, and the tenants are relatively happy to pay low rent, and you want to go in and say, hey, we're going to do some paint and flooring and we're going to increase your rent $300 or $400 a month. They're not interested. They say, hey, the paint and the flooring is not that bad, I don't care, I want the lower rent. So you get stuck there. So yeah, it is difficult. If it's a house with a suite or something like that, you can move into one of the units. You need to live in it for 6 months before you can then re-rent it. But yeah, keys for cash is still a legal, amicable way to make it work. But again, it's hard to get those things in place if you're looking at buying a property, because you can't really pitch a tenant upgrade package or a keys for cash to tenants in a property that you don't own yet, right? So you can take possession of it and then try keys for cash or try tenant upgrade packages, but it's very difficult to do that before you take ownership of the property. But keys for cash, again, everyone has a price point where it makes sense for them to take that money and find another place to rent, right?
Yeah,
So
yeah.
whether that's $1,000 or $10,000 is really dependent on the person. But if you can give them $5,000 towards subsidizing a rent for the next 6 months somewhere else, then that might be something that works for them, right?
Yeah, yeah. I'm wondering if that's now even legal, like this renoviction stuff. Like, I don't know if it's city specific, like the rules are varying. I don't
Yeah.
know. Like,
So the renoviction thing is a bit of a scary scenario right now. In New
yeah,
Westminster, there was a bylaw that was passed
yeah.
that allowed that forced owners, landlords, if they did a renovation on a unit, if they displaced the tenants, kicked the tenants out, did a renovation, they had to give the previous tenants the first right of refusal to move back into the unit when they were done the renovations at the rent they were paying when they moved out.
Oh, oh,
So
it doesn't make sense.
no, it was really bad. And so
Yeah.
that was a bylaw that was passed in New Westminster, and a bunch of landlords got together and tried to take it to court and say that it doesn't match the residential tenancy board, which is something that covers all of BC. And they said bylaws can't write rules that supersede provincial legislation.
Yeah.
And the landlords lost. It was upheld, which set a precedent, which now allows any municipality to basically rewrite their own tenancy rules, which is a very scary situation, because if we end up in the same scenario as that, and unfortunately, the intent for New Westminster was to create affordable housing, to keep rental prices down, because they're very short on rental housing, and there's a lot of people that are homeless and can't find places to rent. So the concept was to decrease the price of rent, or keep it steady instead of seeing huge inflation. What they created was slumlords that don't
Yeah.
have any money to put into their buildings. And a good colleague of mine's uncle sold a building in New Westminster, and the people that purchased it planned to do some major renovations to the building and get rents up, and then refinance. And they were kind of underwater when they bought, but they had a plan to get rents up. And then this bylaw came in place, and it handcuffed them to be able to get rents up. And this building is underperforming, and they're hemorrhaging money every month. And when things fail, when things need upgrading, they don't have the money to fix it, because the property doesn't generate any money. So the tenants are really suffering, because if the elevator breaks, the landlords say, we don't have $25,000 to fix the elevator. Sorry, there's no elevator anymore. And it's really, really not a good scenario what New Westminster's put in for bylaws. And hopefully this doesn't transfer into other cities, because it's going to create these dilapidated, water damaged, rat infested nightmare properties that we see on the news all the time. That's created because of these restrictions on tenants or landlords to be able to increase rent.
Yeah, it's a big multifamily you're talking about there? Or
Yes, it was a large multifamily. Yeah. And
yeah.
it was like a $9 million building, and they can't get rents up. So that property is just, it's deteriorating by the day. So it's,
yeah,
yeah,
it's
not
really
good.
unfortunate. Yeah, I know. Like I kind of in a similar situation now. Like I'm trying to change my tenants. Like I have like 2 properties in Campbell River.
Yeah.
But it's like such a low vacancy there. Some of my tenants, they actually want to move, but they cannot find anything.
Yeah.
So that's unfortunate situation, you know.
It is really tough, and unfortunately, and people don't, or the politicians and government officials don't understand that the demand for rental units doesn't come from tenants. It comes from investors.
Yeah.
Tenants find the place to rent, but they don't create the buildings. It's the investors that create the demand. So the developers aren't going to build any investment properties, any multifamily properties, unless there's investors that want to buy those properties, that want to hold investment properties. So by putting huge restrictions and really limiting the potential income of real estate you're discouraging a lot of investors, and those investors are going to Alberta, they're going down to the States, they're investing their money elsewhere. So developers aren't building any multifamily buildings, which creates a shortage in the rental market. When there's a shortage in the rental market, it's supply and demand. It's just a matter of, you have 100,000 rental units and you have 105,000 tenants, you have 5,000 homeless people is what you have. Until you create 5,000 more rental units, there's always going to be people that are scrounging to try to find a place to rent. So it's really backwards how they're trying to resolve the housing affordability issue. But I mean, that's a political thing that's its own agenda. I think it's completely ridiculous, but I think we might see a swing the other way when hopefully they realize that, you know, handcuffing landlords is backfiring in their face and is not helping the rental housing situation at all.
Yeah,
Right?
I think it hurts everybody, honestly. Like it's all hurts all the sides, you know, like because
Yes, I totally agree. Yeah.
Unhealthy situation.
Yeah, it's not good. It's yeah, hopefully things kind of come around a little bit and make it more reasonable here, for everyone's sake. Yeah. Oh yeah, and Jason asked, institution I mentioned was CMHC, yeah, the Canadian Home and Mortgage Company. They're a government regulated company, and they usually are the company that does the insured mortgages on properties. That if you don't have the full 20% down, they're the ones that actually will lend you the extra 5, 10, 15% down for properties. But they also do large mortgages on multifamily and stuff like that. So if you are a verified multifamily investor that has at least 5 years experience in managing and owning multifamily building, they really want to lend money to you right now because they need legitimate qualified investors to own these assets because they want to get money into the market. So they're actually approaching a lot of multifamily investors and saying, hey, we're going to give you incredible interest rates and really awesome terms if you can go and find some multifamily properties to buy. Unfortunately, they're difficult to buy right now because everything's under rented and impossible to finance. So yeah, we come back to that. Yeah, and Simon, yeah, mentioned that cash for keys can be used to get tenants out sooner. Yeah, I mean, cash for keys is still a legal remedy. It's you fill out a mutual agreement to end tenancy. And you say, if you sign this saying that the tenancy is going to end in 2 months, I will give you X number of dollars. And that if they sign off on it, there's nothing illegal about that. It's completely legitimate contract between two people. You can't force anybody to sign anything, but it is an option to try to get people out if they're, even if they're being very undesirable tenants. If they've been paying rent, it's very difficult to get tenants out, even if they're partying all the time, thrashing the place, drug use. They've got 18 people sleeping in there. You have to go through a big, long, drawn out eviction process that can take 6 months, 8 months, maybe longer. In the meantime, you're losing, they're doing damage to the property. It's very difficult. And in that scenario, sometimes it's best to cut your losses and pay the money to get out, to prevent further damage and to get new tenants in there that are, yeah, going to take better care of the place. So yeah, keys for cash is still an effective strategy. In the last meetup, I did mention that the multifamily property that my colleagues bought in Duncan, they did an agreement for sale. That's how they managed to get the tenant upgrade packages signed by the majority, about 70% of the tenants, before they actually closed on the property, before they actually removed subjects on the property. So they, we had talked a little bit about how you get tenants to agree to get out, or if you have a plan to do a rent eviction or whatever before you take ownership. It's very hard to do when you don't own the property, but if you do an agreement for sale, you actually delay the time where you're actually going to take possession of that property, which gives you time to kind of take control of the property, get the tenants out, and then upon completion you have new tenants in there and you can go and get a traditional finance. That's a kind of advanced strategy when it comes to investing in real estate. That's kind of a lot of over a lot of people's heads. And again, it's really effective on a larger multifamily, not so much a house with a basement suite. Yeah, but it's yeah. And Jason said that yeah, he's used the 10-day notice successfully, and that works if they move out. And the 10-day notice, yeah, to end tenancy for non-payment of rent is a pretty straightforward, well, it's not actually a straightforward procedure, but it is a way to get people out. It's when they have been paying rent, but they're doing damage. It has to go to arbitration, and it can be, you might wait 3 months before you get a court date to go through arbitration, and then you need a possession order, then you need a writ of possession, then you need a bailiff to come in. And again, if tenants know all of the loopholes and they keep paying rent, they know that they can be in there for the next 6 to 8 months, and there's really not much you're going to do about it. So yeah, anyone have any other questions or topics while we're here if they're interested? That's it. I've answered all questions. When is the next meetup? It will be on June 28th at 6 o'clock. It's always 6 o'clock for anybody that yeah, saw the 7 o'clock today. It is always at 6 o'clock. And anyone that tuned in here a little bit late, this is recorded. I will post a link for people to be able to access it. So yeah, should be all right. Yeah, I'm not totally sure what next month's topic will be about. But if anyone has any topics they're kind of curious about, let me know, and I can try to put something together. And yeah, I have a client actually that's done some pretty substantial things in the last few months that I'm really impressed with, and I might have her maybe as a guest on to talk about some of her investments. She went from 0 investments to 10, and in a matter of months, and actually has all of them under contract with subjects removed, and hasn't closed on any of them yet. It was quite the whirlwind scenario, but yeah, I'd love to kind of pick her brain in front of all of you to kind of see how her mindset transitioned from not having any investments to being comfortable enough to buy 3 investment properties totaling 10 rental units in a very, very short period of time. And yeah, how that came to be.
Yes, please ask her to come.
Yeah, yeah, she's yeah, pretty inspiring. And again, I think a lot of people are hesitant to pull their trigger on the first, and I think seeing somebody pull the trigger on that much that quickly will hopefully give people confidence to pull the trigger on at least one themselves.
And in this market too. So did she buy in a town that is going for above asking on most houses?
Yeah, so 2 of them were in Cowichan and one of them was Port Alberni.
Wow.
And all of them will cash flow from day one with very little work involved. So yeah, she was very, and the lesson to be learned from her is diligence. She was on it every single day, looking at listings all the time, analyzing deals just nonstop, and bugging me all the time. Hey, what about this one? What about this one? What do these numbers look like? Hey, can we check this out? And was just actively engaged all the time. And that's what it takes to make it happen, right? People expect investments to kind of land in their lap, and they won't. You have to be out there kind of digging, and she was, and she found yeah, a number of properties, and it worked out really, really well.
And so what she did she find properties that didn't end up being super popular as well, but she saw a sparkle in them?
Yeah, one of them was the $700,000 house that was a 7-bedroom house, and it's funny because it had been on the market for a little bit and didn't have any offers on it yet. It had been on the market for about 10 days when we looked at it, and didn't have any offers. And then we ended up going into multiple offers all of a sudden when we bought it. So it was kind of strange. She bought a sixplex in Port Alberni. We went into multiple offers and went slightly over asking on that one, but it still actually worked, even paying over asking price. We had to jump on that one very quickly. It came on the market, and we spotted it and jumped on it right away. And then a second one that went into multiple offers in Couch, and I believe she paid a little bit over asking on that one, but they still worked, right? So again, it's just a reminder. People say there's no deals out there that work right now. That there is. You have to watch the market every single day, and just so everyone else understands. Like I work specifically with investors that are buying investment properties. I have a number of clients and people. I can set people up on a search criteria that matches their price range, their location, square footage, things like that, and you will get automatic emails. And then you can check those emails and see what's on the market that day and see if there's anything that'll work for you. I can't go through every single listing that comes on the market every single day and then send it off to every single client I have to try to find something that will work for you. You need to kind of be looking for yourself. And again, I can assist you, and I can definitely help analyze properties and set up the showings, and even explain what criteria maybe you should have, what you should be looking for in investments. But people expect me to bring an investment to them and land it in their lap and make it happen. And that's unfortunately not really how it works. I do my best to, when I have clients that have very specific criteria and I see a property that matches that criteria, I will usually send it off to them. But for the most part, you'll be getting stuff through the portal that I set you up on, and it's up to you to go through those and see which ones work, and let me know which ones you want to go see, or ask me to, review your favorites, and so that I can see which ones might work and might not work, right? So that was the difference between this client that managed to buy 3 cash flow investments, and the people that are still waiting on waiting for something to land in their lap, right? You have to be active. You have to be analyzing the properties. You have to know what market rent is. You have to be looking at properties and comparing them side by side. You have to, it's just like anything else. You have to do the work, right? You can't expect to, get 6-pack abs without doing sit-ups. It's just, you got to do the work. We all know what we need to do. And some of us are willing to put a little bit more work in than other people. And those people are the one that gets the results, right?
So will you be my agent for Port Alberni then?
Sure thing. Sounds
Awesome.
good.
I'm going to send you my spreadsheet so you can see the houses I'm comparing, and maybe you can give me some feedback. Sure.
I'll tell you right now, though, if the 4 plexes you're talking about are on Anderson, they're under contract.
Latham is available, or Latham.
Okay, yeah. Yeah, it's been on the market for a little bit.
Yeah, I'm wondering why that's still on. Is it?
It's not. I looked at it. I looked at it a while ago. It's under rented. It's definitely under rented. So it's the undesirability in the fact that it's going to require somebody to go in and get those tenants out or increase their rent, and that's just a huge time-consuming endeavor, right? So if somebody's willing to take that on and go and do rent evictions or do tenant upgrade packages or whatever it takes, then that would actually be a really good asset to have. I think it would make money.
I was wondering too on that one, because there's an extra garage building on that, and it is multifamily. Do you think that you could convert that as well into 2 little suites or something? Did you notice that garage?
It's possible. I don't think that there was any plumbing in the garage, so you have to be running all new plumbing and stuff like that. And one issue that I've been running into with multifamily in Port Alberni is they require a minimum lot size. And some of the properties actually aren't matching that minimum lot size requirement due to current zoning. So yeah, it's something that definitely could be considered. I think that building would take a lot of work to try to get it up to a condition that you could be able to put suites in it. But yeah, there's something that could be done there possibly.
Yeah, I'm a former plumber and I have a carpenter on my side too, so we're looking for a project.
Okay, there you go. Yeah, no, projects are a great way to get a lot of your capital out, right? If you can, yeah, do some renovations yourself, there's sweat equity, and that's a good way to get your money back out and to another investment. So yeah, that's a advantage that you have that other people don't, and everybody has an advantage one way or another, whether it's access to money or skills or trade or knowledge or something, and double down on the abilities you have, the connections you have, the money you have, and make a go of it.
Totally.
Yeah, Jason said maybe a topic about finding other people's money for lenders. Yeah, that's a good one. I could do maybe what appeals to banks, the difference between maybe banks and credit unions. That's actually a very good topic. I very recently found out that RBC will lend on a sixplex as a residential property, not a multifamily, which having little tidbits like that can make huge difference on your returns. So yeah, I can talk about different lenders, hard money, short-term loans, and ways to attract people if you're trying to look to do a capital raise or if you're trying to do a joint venture. Yeah, that's definitely a topic. Yeah, I'll try to write that down and bring that up for next month's meeting.
Exciting. This was fun, Jason. Thank you.
Yeah, well, thanks for coming out. And yeah, it was nice to meet
thanks,
you and
Jason.
everyone else as well.
Yeah, it was really great. Thank you.
All right, excellent. Yeah, if anyone else has any other questions, I'm here. Otherwise, I will, yeah, see you the end of June.
Thank you, Jason.
Yeah, thanks, Jason.
All right,
Thanks.
guys.
Bye.
Bye.
Recording in progress.